Okay. I hope you're not tired.
No.
Yeah, hopefully I'll finish sooner than 20 minutes.
No,
My name is Henry Ejay-Buapia, and I am Associate Professor of Accounting at the University of Southampton. I'm presenting to you on the topic Information Sharing and Loan Default in Developing Countries. The real emphasis will be on the moderating role that bank market concentration plays, bank market concentration and then national governance quality plays in the nexus between information sharing and loan default rate. I'm actually presenting this on behalf of my co-author, who is Samuel, who is not here, but I hope to be able to do a very good job on his behalf. We have a lot of other co-authors. So apart from Samuel, we have Albert Danso, Professor Intim, and Emmanuel Adibite, all academics here in the UK. The key issues that we focus on in this paper are loan default rates, developing countries, credit information sharing, national governance quality, and then banking market concentration. Most of these things, you will agree with me, have got some sort of impact or connection with financial inclusion. Fintech, I'm not quite sure, but economic growth maybe. So let's look at the key issues that we focus on. We try to address three main questions in this paper. The first one is, do credit information sharing, when banks share information among themselves, does it really have any value? Value in terms of reducing, what we call it, the default rates. Then the next question that we look at is whether the impact of credit information sharing on loan default is actually different when we look at the structure of the banking market. In other words, if the banking market is more concentrated or less concentrated, are we going to have more or less value from bank sharing information? And then the third one that we look at is the moderating role of the broader macro governance environment on this very relationship. Let me start by looking at why we ask these things. So how do we motivate our study? The first one got to do with policy issues. Looking at the literature, we realized that between 1991 and 2005, about 17 out of 27 transition countries in Eastern Europe have actually established credit information sharing schemes. So this is something that is taking shape in a lot of developing countries. And then based on our own computation using World Bank information, we realized that the depth of credit information sharing index has actually increased by about 72% over the period 2004 to 2012. So essentially, banks are sharing more information among themselves. But the question is that when we look at another set of data that looks at the loan quality of banks, we realize that across the same period, 2004 to 2012, the loan quality of banks are actually deteriorating. So the key issue is that why is it that banks are sharing more information among themselves, but we have loan quality declining? That is quite intriguing, and it made us to want to focus and delve deeper into this. The other thing that motivates our study got to do with the literature. The literature actually suggests that when bank lends in an environment that are opaque and that have got weak governance arrangements, we tend to find that information sharing should reduce information asymmetry and also reduce adverse selection and moral hazard problems. Credit information sharing among lenders, we expect that should reduce this. And actually, the literature suggests this. The empirical evidence tells us that when banks share information among themselves, we tend to have more bank lending. So based on this, we actually come up with this framework that explains why we're doing this study. So when banks are sharing information, we expect that information asymmetry should reduce more broadly. And the channel for reduction is in two ways. The first channel is through reduction in adverse selection, which is when banks share information, we expect the lenders to have more information about the characteristics of the borrowers. And that should help them to do better screening exercise. That should lead to improvements in loan quality, and that should lead to reduction in loan default. The other channel got to do with moral hazard. That is the demand side. When borrowers know that information about them will be shared among banks, we believe that, or the literature suggests that that should instill more discipline among them. It should help them to, or encourage them, incentivize them to pay their loans and also reduce overborrowing. That should also lead to improvements in loan quality and a reduction in loan default. So essentially, all the arguments suggest whether adverse selection arguments or moral hazard argument, it suggests that when banks share information, we expect to see a reduction in loan default. We have two other questions that we deal with. That is the moderating effect of this relationship between information sharing and bank default, the moderating effect of banking market concentration and national governance quality. And this is how we come by that. The literature suggests that in concentrated markets, when the banking market is very concentrated, we tend to have very large banks, very small number of large banks. And that leads to banks becoming too big to fail. So the banks themselves are too big and they tend to take much more risk. We also see that in concentrated markets, the banks tend to develop more long-term relationship because borrowers don't switch their banks easily. So it leads to long-term lending relationship. That can also lead banks to become more risky in the sense that they don't make lending decisions based on economic information available to them, but they make the decision possibly based on what we call soft information. Because they know them, because they are closer to them, even if the fact says that you shouldn't lend, they probably would do the lending. So we expect that overall, in concentrated markets where we've got very few banks, we expect risky behavior to be quite high. And in such an environment, maybe they already disregard credit information sharing. And for that matter, we expect credit information sharing to have a minimal impact there. The other argument comes from national governance quality. We borrow from the institutional theory which suggests that outcomes of business actually vary depending on the quality of governance that is prevailing in a particular environment. Governance quality, we mainly rely on three main governance quality. One is the regulatory quality, rule of law, control of corruption. If all these regulatory environments are good, then we expect that when you put in place a credit information sharing scheme, that will be able to yield much more benefits. So our three main hypotheses that we test are as follows. One, credit information sharing, that's quite obvious. We hypothesize that it should reduce loan default. And then the next one, the effect of credit information sharing, we expect it to be mitigated by banking market concentration. And finally, we expect the effect of credit information on loan default to be enhanced by national governance quality. So this is by way of motivation and the literature. Let's now look at the data and the methodology that we adopt. We get our main data from Bankscope. And then we also get our data, information sharing variables, we get it from World Bank Doing Business. And then other macroeconomic variables, we get them from World Bank development indicators. Governance variables also come from there. Finally, we have a sample made up of close to 900 unique banks across 87 countries that include a number of African countries. Our empirical strategy is as follows. We employ the GMM model, where we model non-performing loans as a function of itself, and then information sharing. We control the CR as the concentration ratio of market. MG represents macroeconomic variables. BS represents bank-specific variables that we control for, like bank size, capital, and other things. Our key variables are there. We can talk about that if you are more interested. So we move on to look at the descriptives before I present the main results. So the key thing that we find is that the mean non-performing loans is about 6%. So about 6% of loans that the banks in our samples give actually turn out to be bad. And then information sharing index, the DEF represents the information sharing index. The mean is about 3.5, which is a bit high, quite close to the maximum, which is 6. The banking concentration ratio, also that one is about 0.56, which tells that our sample is actually very highly concentrated. Now let's look at our main results. So the main results that we find is as follows. We find that indeed our hypothesis 1 is supported. It's supported in the sense that when banks are sharing more information, or the quality of information sharing among banks is high, we realize that loan default rate is actually quite low. So essentially, information sharing tends to reduce the loan default rates in developing economies. In models 4, 5, and 6, the dependent variable there is bureau. We use bureau. Bureau is establishment of private credit bureaus in a particular country. It tells the same story, essentially. Let's look at our second hypothesis. Second hypothesis, we tried to see whether the effect of the banking market, the banking structure, actually has any role, enhances or reduces, whether it moderates, actually, the effect of information sharing on loan defaults. And what we've realized is that in concentrated markets, when the banking market is concentrated, in other words, less competitive, we find that sharing information among banks actually tends to increase the loan default rate. The same thing is found if we use a different measure of information sharing. Hypothesis 3, this is where we didn't get any clear results. That is when we look at the governance quality. So in model 1, we look at the rule of law. In countries that rule of law is quite strong, we realize that when they institute information sharing mechanisms, it doesn't have any statistically significant effect on loan default. The only variable there that seems to have some moderating role, but even that is marginal, is regulatory quality. That seems to reduce or enhance the effect, the positive effect of information sharing on loan default rate. Let me finish off by emphasizing the conclusions and the main contributions and policy implications of this study. So our main conclusions are as follows. In developing economies, where information asymmetry problems are quite acute, we realize that when banks share information among themselves, it seems to lead to a positive outcome, which is essentially to improve the quality of their balance sheets. However, the benefits are not, universal across all banking markets. We realize that when the banking structure is concentrated, then instituting credit information sharing scheme may not really yield the effects that one wants. So essentially, when countries want to institute credit information sharing schemes, it might be a good idea to do that alongside trying to make the banking market more competitive. And then finally, we found out that the reductions in loan default rates resulting from information sharing is largely independent of the governance quality. In other words, it doesn't really matter whether macroeconomic governance environment is strong or not strong. When you bring in information sharing schemes, it tends to have almost the same effect. The key contributions of this paper is that we look at an understudied sample. Most of the work in credit information sharing is about developed markets. We are looking into developed countries, developing countries. Let me move to the policy implications and end it there. So the first policy implication is that when we institute information sharing schemes in developing countries, it is a very good thing. It tends to help the banking system. So that is something that countries are encouraged to do. The second one is that the benefits that we get from instituting information sharing schemes, reforms that bring information sharing scheme need to be accompanied by reforms in the competitiveness. I think I've made that point already. And then finally, improving the regulatory quality of a country may enhance, we are not sure about that, but it may enhance the benefits of information sharing. I think the presentation ends here. Thank you.
Just a quick one for you. You said you got quite high concentration ratios there, and I think knowing the bank scope data, that might be attributable to the fact that the smaller banks, which probably dropped out of your sample, are the ones who don't report non-performing loans. So I'd probably recommend to look into your sample and see the observations where they have non-performing loans reported and those that don't, and see if there's a systematic difference between the size of those banks, because it might be capturing a bit of bias there.
Great.
All right. For me, I think in economies where you have concentrated banking sector that are concentrated, macro shocks, economic shocks are more, severe in such economies. So, should you look at, financial crisis, the impact it has on their loan books? Because it might just not be right just to link it to, the default happening due to non-sharing of information. It might just be due to macroeconomic shocks. Maybe it's something you need to look at or talk to us about.
Yes, I was a bit puzzled by your result on concentration, and maybe Johan has the answer there to do with the bank scope data. But if we think of, say, a completely concentrated market in which there's just one bank, clearly information sharing wouldn't add any value because the bank would have all the information, right? And think of it, then you have 2 or 3 banks. Again, there are diminishing returns. I can see that. If you have big banks that are controlling big segments of the market, the information sharing isn't going to help them very much, right? So in a competitive market, obviously, it's this information sharing is going to be more important. But I can't see how it can be negative. I mean, how can concentration basically mean that information sharing is negative? I can see it being zero, being negligible, being small, but not necessarily negative. But maybe there's a bias there that Johan has suggested. So perhaps it's something worth looking at again. Thank you.
Okay. I just also want to add to what has been said earlier on. And since you're also using bank scope and you are interested in looking at the concentration of the banks, which mainly measure the market power of the banks. So I may suggest that if you look at more appropriate measurement of the concentration, here I'm looking at the linear index or the bone indicator. They measure the market power better than concentration.
Very good. Yeah, thank you very much for the questions and the contributions. Actually, the paper is published, but it doesn't mean that your comments are not necessary. Because we're working on similar projects, so the comments are very, very important, and they can help us in the other papers. The issue of about size, it's right, all the smaller firms drop out of the sample, so we tend to have most of the firms in our samples tend to be quite large. We'll probably have to look into the smaller ones as a separate thing to see whether we find any huge differences. And then the question on financial crisis. Yes, you are right. In our robustness tests, we actually, when you look at our sample period from 2007 to 2012, it covers the financial crisis period. And what we've done is that we take out those periods to see what we find, and our results still remain quite robust and strong. So financial crisis doesn't seem to disturb our results at all. Actually, it was one of the reviewers that suggested that. And then the issue about concentration, I think, yeah, the arguments that the professor has given, it's sound. Why market concentration should have a positive effect. At least maybe it should have a zero effect. What we thought about it hard. We were not expecting that, by the way. So our thinking suggests, so what we came to is that it could be that because when banks are sharing information, I don't know, it will be difficult. Probably I'll have to speak to you later about that. I don't think it makes a lot of sense thinking through it myself. So I think your argument about zero effect probably makes a lot of sense, but we can't explain why it should really increase that. I think I've answered all. Thank you.
There is one last question. Sorry. Yeah. Gender balance.
Yes, I was having a question about what you have underlined, the too big to fail. So the size, when the banks choose to increase in terms of size. And we know that maybe in developing countries and maybe in African cases, banks choose maybe to increase in size through merger and acquisition. And through those channels, they have maybe found to improve also some, as I can say, scope efficiency. So better share information internally through merger and acquisition. So how, or maybe a question is that at this moment, if we just look about the history, have they also improved information sharing through those kind of channels, merger and acquisition? And because you have underlined too big to fail, is there a real effect? And if there is a real effect, how can we just look those effects on the risk default on loan that you have just underlined? So I don't know if you have looked through those questions in your paper.
Yeah, thank you very much. Too big to fail, we've not actually addressed it as an issue on its own. We looked at it in relation to banking concentration. And we realized that in concentrated markets, banks tend to be very big. And for that matter, they assume that state of too big to fail, which makes them want to take on more risk. Because their risk appetite tends to be quite high, we believe that when the information is being shared, which probably links to the professor's question, they will disregard information sharing issues. And also it relates to what I mentioned about long-term relationship with customers, building that. They will lend not based on even when the credit information report is telling them that it's not good, but based on the personal touch that they have with them. M&A issues, we didn't really go into that, but I think it's interesting, and we'll have a thought on that. Thank you.
Okay. Thank you.